You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, so let's start with last week's trade. We looked at a trade in AMD, and I'm kind of excited about this trade because what we did was a fig leaf last week. And as you know, with Options Playbook Radio, we don't really get to choose where the stock prices are at because we usually tape it at a traditional time every week. Last week, we taped Options Playbook Radio on a Thursday. The markets were open. And guess what? We're taping Options Playbook Radio today on a Thursday, and the markets are open. The date today is the 24th of June. Last week, it was the 17th. AMD at that point in time was trading just above 83, and we looked at going deeper in the money and buying an actual fig leaf on that underlying stock. Now, they have some news that's in on AMD. NVIDIA, another chip maker, has announced a 4-for-1 stock split. NVIDIA is actually buying someone out. We talked about trying to have a position in on it, waiting for that merger to happen, and hopefully AMD stock will take off after that. But we wanted to limit our risk as opposed to buying 100 shares outright. So we bought an in-the-money option contract as a substitute for buying the stock outright, and we sold a shorter-term call. Now, what makes me excited about this is that the market basically stayed a little bit flat, went down a little bit, up a little bit, didn't really make any big moves. But right now, today, the underlying market is up, and we see NVIDIA trading right now at 85.57. Now, that's a live quote. The markets are moving. And the call that we sold was the 86 strike call. That expiration is the July 2nd expiration. So we are not there. We have a week or so, a week and a day, 6 days worth of trading, I guess is a better way to say it, before that expiration date. So this is a classic example of I did a fig leaf. I've sold that call. I don't own the stock. I own something that acts like the stock, and hence that's where the name of the fig leaf came with inside the Options Playbook, in that I have something that looks like a covered call, but it's not a covered call, so I'm kind of covered. As far as the brokerage firm is concerned, I'm covered. I don't have additional margin above and beyond the net debit that I paid for that trade. But if I get assigned, I'm going to have to do something. Why? Because I don't own the stock. I just own an option contract. So we always talk, whenever we look at fig leaves, we always talk about the need to do something if the stock gets to your short strike before that expiration. And right now, we just happen to be taping Options Playbook Radio, and we are 40 cents away from our short strike. So to me, this would be the time when you would think about doing something. So what can we do? What's the do something? Easiest thing to do is just close out the trade. We were correct on our forecast. If we want to, take our profit and run, we could do that right now. So if I go and I look at this underlying trade, we went in and put this entire position on last week for a net debit of 1606. The market has made a run up. It's at 85.57. And we could now go out and sell that trade for almost $18. We'll call it $17.90 on the midpoint. So a decent profit, especially considering that if you look on it on a percentage basis, but I don't like to look on it as a percentage basis because we're really thinking about, well, the monies that we would have used would have been enough to buy 100 shares of stock. So I don't really look at it as to what we actually risk, because we're not going to go out and use the leverage and buy as many fig leaves as we possibly can, right? We're just using this as, well, we had around $8,600 to go on out and buy this underlying stock overall. And instead of that, we bought this option contract in general. So with that said, that would be the simplest thing to do. But in most cases, we would go out and roll this position. I have a section inside the Options Playbook that is titled How We Roll. It's also in optionsplaybook.com under the tab Managing Positions. And we always say one of the biggest things about covered calls or fig leaves is that a lot of people wait too long. They let the option contract that they sold get too far in the money, and then they say, oh, please help me out. Brian, my option is deep in the money and we're close to expiration. What do I do? Well, at that moment, it's basically like saying, I've just driven my car off the cliff. I know it may be totaled, but could you please fix it? That would basically be my analogy. You need to do something before the car gets off the cliff, right? You need to make an adjustment so you don't go off the cliff and you still have a chance to keep your position in check, if you will. Okay, so if we were to roll that trade, we're going to go out and look at just rolling 1 week out. Now, if we roll 1 week out, that means we're going from the July 2nd expiration to the July 9th expiration. And whenever you're rolling up and out, the goal usually is to do it for a net credit to the account. Now, I want to emphasize that when you roll, you are taking a loss most of the time. I guess not all the time, but 90% of the time you're going to be taking a loss on the initial option contract. And you are going to be then hoping that the underlying will stay below the new contract strike price. We get it done for a net credit, and net, that entire short option position is a gainer when it's all said and done. Okay, is a profitable position. I don't know where I came up with the term gainer, but we'll just run with it. All right, so with that said, the July 2nd contract is the 86 strike call. And the July 9th contract, if we just go out 1 week in time, is going to be the 87 strike call. Now, right now, with the markets hopping, the stock's at 85.60 approximately. It's like I said, it's moving. We can get this done for a net credit of 11 cents to the account. Now, we're not doing it to necessarily bring in a net credit, like a profitable thing. We're just trying to avoid assignment. So we can add 1 point onto our strike, lower the likelihood that we are going to be assigned, and just add 1 week of time to our expiration date. So the July 2nd is about 8 days away. we're about 40 cents from the strike price. Now is the time to think about rolling the position, or what am I going to do if it actually gets to our strike? And as I mentioned, the first one was we could just sell it and move on. Second one was we could roll it. Now, if I'm willing to go out further in time, if I think I need to get a little bit further away, AMD actually has weekly contracts, as you probably know. And if we wanted to, we could go out one more strike up and go out one more week. Actually, if we go to July 16th, the July 16th expiration as opposed to the July 9th expiration, we can go up to the 89 strike call. And right now, we can get that done for very close to even. Not a net credit to the account. It would either be a 1 cent debit or a 1 cent credit to the account. And once again, we're just trying to avoid assignment. So this might be a better option in your mind, because we're going to go up one more point and we're going to go out one more week. So quite simply, if we're rolling our option position, what would be done, the way the order entry would be made is that we're buying to close the July 2nd 86 strike call, and then we would be selling to open. In this instance, I'll use the last example, the July 16th 89 strike call, and we're going to do this for, let's say, a net credit of 1 cent to the account. A lot of people would just like to get a very minimal credit overall. Might be a little tough because the midpoint is at even right now. But with that said, it's a very liquid underlying, and maybe you could get it done for a net credit of 1 cent to the account. But that is the concept. If I have a fig leaf on, we've done quite a few of them and talked about them, but we've never had a situation where the stock was right at the strike price when we were taping Options Playbook Radio to just talk about how we roll that position. And we have a very interesting scenario. Now, this is a good thing, right? Overall, we want the stock to go up in price. It would be nice if it would have just go up, just stop right here and wait one more week before it continued on up, right? We were just a little bit off on our timing, if you will, on our expiration date. I'd feel pretty comfortable if we could wait one more day and Friday and just say, okay, I hope it actually stays below that 86 level. But that's not the case. So life happens. We have to roll this position, or we have to close this out and move on. In my scenario, I would probably roll it. But as always here on Options Playbook Radio, it is not meant to be a recommendation. Okay, so what has happened in the markets over the last couple of weeks? We've really seen a switch from the financials actually kind of leading the way ever since the Fed has spoke. We had some bad jobs numbers today, overall unemployment, and the market is up. It took it with a grain of salt, and the market is just basically flat to up today. So now the focus has really been on the NASDAQ stocks. A lot of the FANG stocks are bouncing back, and also the healthcare stocks, which I'm not quite sure why we haven't really had a strong push in a lot of the healthcare stocks. I mean, they've done well. Obviously, if you were in a lot of the healthcare stocks before the vaccines came out, you did pretty well, but you didn't blow the doors off. So we're going to stay in that scenario. We had some good news on Moderna today. Moderna basically came out and said that, or they determined that their vaccine is doing very well against the Delta variant. So to do well against the Delta variant seems to work well for option trading, right? See that what I did there? So they're talking about the Delta variant. Options have Delta. So why not do a trade on Moderna? And I want to take this opportunity, as always on Options Playbook Radio, as a way to look at a strategy that we've talked about and a hedge that we've looked at, where we put on a long call spread, and if the market goes against us, we roll it into a butterfly. That means we're bullish on the underlying. We're going to sell that at the money call and buy a little bit in the money call, but we're selling more time premium than we're buying. And we're going to flip it. We're going to do the same type of trade, but we're going to use puts. And I want to show that this is possible. As opposed to buying a long call spread, we're going to sell a short put spread. And when we sell this short put spread, we're going to be bringing in a net credit to the account. We're going to be doing the very similar strikes as if we had picked the long put spread. We're going to have the exact same profit and loss graph basically as the long call spread. And I just want to show you how you set it up, and we can still turn this into a butterfly if we wanted to. But things kind of change, because one of the biggest things about trading options is the lower price options literally have better markets. And so if I sell the put spread and I'm correct on my forecast, the market goes up, the value of those puts are going to go down in price. It's being a little bit easier to close it out. As a matter of fact, if it went up enough before that expiration date, the options would just expire worthless and you wouldn't even have to close out the trade. So I just want you to be aware of the fact that this is possible. I think it's a little bit harder in general if you're a basic option trader to just kind of put your head around the fact that I'm going to sell an option contract that is right at the money, and I'm going to buy an option contract that's out of the money. I'm going to bring in a net credit to the account, and how I'm going to actually roll that into a butterfly overall. But let's get to the trade. I'm getting a little long in the tooth. Okay, so here we go. Moderna right now is trading at $219.57. The stock is up $7.53. The market took it as good news that the Delta variant, that the virus is very good on that Delta variant that is being discussed all across the world. And we're going to be 5 points wide. So the maximum this could trade for is $5. The midpoint on this trade is $2.60 right now. So I guess I need to give you the strike prices, right? We're going to use that same expiration that we were short in AMD. We're going to use the July 2nd expiration. We're going to go out 8 days in time. We are going to sell the 220 strike call, the most at the money strike call with Moderna at 219.57. And then we're going to go a little bit out of the money in this instance with puts. It would be considered out of the money. And we're going to buy the 215 strike put. Now, that means that we want that underlying stock to literally stay where it's at or drift higher. We would like it to finish above 220 in that situation. That means we could make the maximum on our trade, which is the $2.60 net credit. If it continues on up over the next 8 days, even in the next couple of days, there's going to be a lot of time decay in these option contracts. We have a fairly expensive underlying. We have it trading right around 60% implied volatility. So a few days worth of time decay will be a big deal. So if we could even make it till Monday of next week, it's only an 8-day trade overall. Time decay would definitely be our friend. Now, if the market went down, this is the way that we would roll into the put butterfly. If the market went down in price, the situation would be that these option contracts would be more in the money, but what we would end up doing is selling another 220 strike call and then buying the 225 strike call overall. Now that is a long put spread, and we're going to have to pay a net debit for that position. And I want to make sure that that net debit isn't more than the net credit that I received overall. But if it's a little bit more, that's okay, because if that does happen, I still have a chip in a chair. I still have a chance. So if this thing was, that long put spread was trading for, let's say, $3.60, all right, if it was trading for that, I could put this position on, and then my maximum upside would still be the width of the spread, 5 points. I'd still want the underlying stock to come up to the 220 level, but my maximum risk on this trade would be $1. overall. Why? Because I brought in a $2.60 credit. I put this position on for a $3.60 net debit. I'm down $1, but I still have a butterfly position on. So how would I address this? Well, I want to see what my net debit would make me comfortable. What type of risk would make me comfortable? I want this underlying to run, and I want to give it time to run. But if it goes against me and I see this thing trading, my long put spread trading for $3.60, maybe $4, I am going to then go in and put that position on, and I am going to have an overall butterfly to my account with a limited net debit of risk to that position overall. All right. So you're going to have to work that one out. You're going to have to go back. And if you look at, we did quite a few long call spreads where we did it the opposite way. And it's much easier to think about it if you're going to be long using calls. This is just an alternative if you're using puts. And if you're more bullish, if you actually think the underlying is going to go up, well, obviously you sell a put spread, it's much easier to manage because if the underlying goes up, the options could just expire worthless, and then you don't have to do anything to actually close out that position overall. So it's an interesting way to approach that trade, but it's a lot harder to understand from the put side. All right. Well, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.